Real Estate Radio TV, the web radio 100% dedicated to real estate.
Welcome to Real Estate Radio TV for a new interview. In today's interview, we have here to welcome Christopher Mertlitz, Head of European Investment at WP Carey. Hi, how are you today?
Hi, thank you very much. It's a pleasure to be with you today.
All right, to start off, what I propose is you introduce yourself, talk a little bit about your business background as well as your role inside WP Carey.
Sure, thank you very much. So, as you said, my name is Christopher Mertlitz. I'm the Head of European Investments for WP Carey based here out of London. And my primary responsibility is to oversee the origination, structuring, underwriting, and ultimately closing of the projects that we close here on the European continent.
And for those that may not know, could you give us a little bit of an overview of WP Carey, give us a little bit of an insight on its history and structure, and give us some number like assets under management?
Absolutely. So the company was founded back in 1973 by William Porker Carey, who really pioneered in many ways the concept of the sale and leaseback, which is a very, very efficient way for corporates to raise capital from their corporate real estate. And ever since the beginning of the firm, we've stayed true to our core principles and our core competency, which is to structure these often very bespoke real estate transactions and corporate finance-led transactions, utilizing real estate with a primary emphasis to provide capital to the corporate tenants that need that money, but at the same time to generate long-term inflation-protected income streams for us and our investors. And that business model has worked very well over multiple cycles, over decades, in fact, and is basically the core reason why we never had to change it, because if something works well, you run with it and don't change it. As far as the company today, we manage something like $25 billion in assets under management. It's about $20 billion if you look at enterprise value of the firm. It's a bit larger if you look at how many assets we manage. And yeah, it's a business model that has worked very well over decades, and we've expanded it because of its portability to many, many different countries now. And for something that really originated out of the US, as historically speaking, we currently have investments in about 25 countries. Most of these are in Europe, really from the north of Norway down to the south of Italy, from the Baltics in the east to Portugal in the west. And it's today approximately weighted something like 36-ish% in Europe and the remainder in the US. And yeah, things are working very well. We are one of the few companies that have such a long dividend track record, like the way we have it. And hopefully we'll soon be in the very illustrious Dividend Aristocrats Index, having soon paid 25 years of uninterrupted growing dividends, which is obviously very, very impressive and one of the key drivers that give us this favorable access to capital and is very important to our income-seeking investors.
Like you mentioned, you specialize in leaseback. Could you maybe talk a little bit about this type of investment and what are the benefits of actually doing a leaseback instead of just buying a property with an existing lease?
Sure. One of the key benefits is really the access to the company. And when I look at a project, for me, it starts with the credit. I need to understand, is this a business I have fundamentally believe in that they will be around for decades to come to pay their rent? It's a pretty fundamental question, because really the value of the building and the value of the lease, and hence also the quality of the tenant, those are very linked concepts. Building is only worth as much income you can generate from it really over time, as ignoring now trying to sell it at some point. So it's all about understanding the quality and the security of the income that we can generate over decades from these buildings and from these leases, and hence that means also the tenants. And that kind of links already back to your question, like, why do we prefer sale and leasebacks? Well, that is one of the rare cases where you actually have access to that tenant directly. You can sit together with the company's CEO, CFO, finance directors, and others, and really try to understand the business itself, and that's the credit. But then the second part, which is often overlooked and really the most critical part, I already said the word criticality and critical, the importance of the buildings. the importance of the assets and of the portfolios, if it's multiple properties that we're acquiring, that is so relevant. That's very critical to understand. Why are these buildings important to this business? Why do they need them? Why would they want to stay here forever? And again, that's, you need access to the company to have the ability to ask these questions and to fully understand the full picture. And that's naturally why we gravitate towards sale and leasebacks, because you can structure those long leases, you can structure bespoke projects for these companies, and you can ask all of these questions and get reasonable answers. And so naturally, that's why we gravitate towards the sale and leaseback, because it's a very rare blend between the world of real estate and the world of finance, and very few people are actually good at it. And so we have a 5-decade track record in that space, which is helping us certainly underwriting these projects and then making sure we see good deal flow and we can properly allocate and properly underwrite risk. That's at the end of the day the core principle in any prudent investment.
Right, it brings benefit for both the investor and the tenant. And so could you talk a little bit about the lease structure, in terms of periods, agreements, yearly increments you guys like to use when executing a leaseback?
Absolutely. So if we take a step back and what are we all about? We're all about long-term inflation protected income. So again, these are three distinct, they're kind of related, but they need to be appreciated as a whole clearly, but individually they kind of point you already in the direction of what we're actually doing. Long term means long leases, 20 years, 30 years. It's very common for us. The longer generally the better, because it gives you a more predictable income stream, it gives you a longer time horizon, and the residual value risk or the potential value of a building at the end of the lease term is pushed out further into the future. So clearly long leases, as I said, 20, 30 years is relatively common for us. Sometimes it's a bit shorter. Obviously, every single deal is different, but all else being the same, generally longer leases are better. Then the second part I said is inflation protection. So a large proportion of our deals have CPI linkage in some shape or another, maybe uncapped, maybe capped, maybe with a floor, maybe fixed increments. But I would say the absolute vast majority of our leases have inbuilt rent escalation. So it's to upkeep with the inflation protection. Again, that's the second part. And then the third really is the income generation, income preservation. And that tells you a little bit about our time horizon. And as a publicly listed REIT, we do not have to sell assets. If you want to get exposure to WP Carey, buy some stock. If you would like to reduce exposure, you can sell some stock. But that has nothing to do with the underlying portfolio. So in principle, unless there are some certain special situations, our hold period is very long term. And we really hold on to assets often for decades. Again, coming back to long-term inflation protected income generation. So that's how we structure leases. That's how we look at it. How can we preserve income? How can we generate income? And how can we generate specifically inflation protected income?
And sometimes what we see in leaseback leases is what we like to call a buyback option, where a tenant can buy back the asset, for example, in a 5 to 7 year period if they choose to. Is that something you sometimes include in your leases or not?
So buyback options per se, yes, do sometimes occur in these deals. Certainly not in every deal. And generally when they do occur, I would push for them to be very much at the end of the lease term or many years in the future. Short-term leaseback deals or short-term buyback options, I don't like. Why do I not like it? Well, because fundamentally it impacts on our ability to forecast for many years to come our expected lease income. If you have many buyback options in your portfolio that are relatively soon, you might find yourself in a point where your tenants start exercising these buybacks, you end up sitting a lot of cash, but you're losing income. So generally speaking, buyback options sometimes are structured into these deals, not certainly in every deal. And if they are structured, the intention, the focus, and obviously it's always a negotiation, right? I mean, we're not operating in a vacuum. It's always a negotiation with your counterparty, but certainly my starting point would be that it's at the very end of a lease, if at all. And like I said, I need re-emphasize that point. They're more of an exception rather than the norm in what we do.
And in real estate, especially commercial real estate, diversification is key. Especially for a group like yours that has proven to be successful for more than 25 years. I know you guys, diversify a lot into different, real estate sector. So in what kind of, real estate sector are you currently investing in and have invested in the past? Is it more the industrial sector, retail, hospitality, healthcare?
Yeah, that's a good question. But I can give you more than happy to give you a background of what our current allocation is at this point in time. It's approximately half of our portfolio is in industrial, logistics, warehousing, production, manufacturing. That's about half. And then again, approximately 20% would be in retail, about 20% would be in office, and about 10% or the balance would be in pretty much anything else. And it could be hospitality, could be other specialized real estate that might not fall easily into these categories, like specialized R&D or other properties that you couldn't easily categorize. So that's broadly speaking our portfolio allocation. But when I look at a transaction, I don't really start off necessarily by looking at our portfolio and thinking, let's overweight this asset class over another class. I first start with the same fundamental principles that we look at every deal, which is, do I like this credit? Is this fundamentally a business that I believe in for the next decades to come? And do I like this management team? How are they capitalized? What industry are they in? What are their margins like? How much cash coverage do they have on their obligation to pay rent? What's the maturity schedule look like? And so on and so forth. So these are all very credit-related questions and many more in addition. But then the next point would be, why are these buildings important and critical to this company? What links the business and the real estate? What's that link, and how can I understand that better? And for these first two questions, I haven't even really asked yet what the real estate actually is. Is it a logistics building? Is it a production site? Is it a retail property? So we are looking at slightly the other way around. We start off by finding tenants we like, structuring deals around their mission critical real estate, and the portfolio allocation that you see today in our portfolio is a consequence of those steps rather than the other way around, rather than us saying, we want to have 50% in this asset class, 20% here, 20% there. So it's a different process, which ends up in this particular allocation. So I hope that answers your question to a degree at least.
Right. So you basically trying to find the good tenant first, and then the real estate is second, but you really focus on getting that tenant that's going to stay for the long term, where you see potential. And I think when you say that 50% of your assets are in logistic, the future is logistic, with the development of e-commerce and everything. And we see a big lack of supply in the logistic area. And I'm wondering, how are you impacted during the crisis between rent payments, tenants' defaults? Could you give us some insight on how you were impacted, and if this strategy of triple net leaseback of portfolio has found itself to be a recession-proof portfolio?
Absolutely, and I think that's one of the points or developments we really, as at WP Carey, should be and can be very, very proud of. If you look at the impact that COVID had on the world economy, on obviously society large and in all of our lives, it was unprecedented. Is really in many ways an understatement. But if you look at the performance of our portfolio, we fared very, very well through COVID as a business. And I truly believe it is because of the combination of the first 2 points that I highlighted, which is the credit-focused analysis to really understand the business of our tenants, and secondly, the focus on the critical assets, the ones that they really would want to be operating even when there is COVID occurring, and even when there's a global pandemic. Those assets they want to keep paying rent on, they want to make sure they keep operating because they're so mission critical to them as a business. So when you look at the rent collection rate, which is maybe one of the easiest metrics to look at, throughout 2020, we naturally saw a small dip at the beginning of Q1, beginning of Q2 in 2020. But and please, you can fact check this. I think this would be a good thing to fact check. We dropped maybe at one point to 96% in that territory in rent collection on a month-by-month basis. But that number, which again is not bad given the context of the global turmoil we were under, very quickly recovered afterwards, and basically close to, if not very close to 100% as of today, and already recovered very strongly back towards the 100% level, even in 2020. So from an overall rent collection perspective, we did not really see a big impact on our portfolio, and certainly a lot less of an impact than a lot of our peers might have seen.
Your European HQ is based in London. A major event that happened, a couple of years back and still affecting today is the Brexit. Have your investment strategies for the UK and Europe changed at all because of the Brexit?
Yeah, Brexit is an interesting one. There is clearly there's happened a bit of a shift in terms of the prevalence or the preeminence of the British market as a real estate market relative to maybe other Central European or continental countries. So we've seen some, on a macro basis, some investment volume shift maybe a bit away from the UK towards Germany specifically as a consequence of Brexit. But for us directly as a business, we have the benefit of time. We have the benefit of being a long-term investor. We have the benefit of not having to worry about the day-to-day, month-to-month news cycle. And if you sign a 30-year lease with a company that you have a lot of faith in their operations and their importance of their assets, if you do such a long lease with a business in the UK, it is, clearly you need to factor Brexit into your calculations and in your assumptions. But again, if you have a 30-year income stream, no one really knows where the world will be in 30 years, right? But we can take some reasonable views about that and don't have the day-to-day, month-to-month, sway too heavily in our underwriting. If we were a fund that planned to liquidate in 2 years' time, 3 years' time, back when the vote happened, clearly it would have shifted our view on doing more deals in the country. But if you have that long-term horizon, you can weather those storms and you can ride them out, and you have the benefit of time on your side, which is generally what you want to have in investing in life in general. So yeah, Brexit itself clearly a big change in many ways, and it might have focused specifically in the UK market, even more focus on supply chains and vulnerability of supply chains and ongoing trends, and called a macro, bigger trends of reshoring production and supply chain stability has become more at the forefront of people's minds, which again triggered more and more investment in logistics, industrial distribution, specifically in the UK. But overall, if you look at us as a business, the UK is clearly an important country for us, but it is also one of many countries for us. We, as I mentioned, I think at one point we have something like 20 different countries in Europe that we invest in. Clearly, UK is one of the larger ones, but still, it's one of 20 countries. So it's not like it really swayed us too much or created some material changes in our underwriting. It did not. Talking
about your latest acquisition, one of your latest acquisition in Europe, and more specifically in France, was the purchase through a leaseback of 4 supermarkets for around 110 million euros. Could you talk specifically about this investment and also the acquisition process?
Sure. So this was an off-market transaction which we closed earlier in the year. And it's a very, very typical case, actually, where we were able to secure this project through a local personal relationship, and where the value of the relationship matters is, again, in these off-market transactions where you can secure a project before they go into a broad marketing process. And yeah, it's in many ways a deal where through our ability to structure these transactions, we were able to enhance the deal in a very meaningful way to make it very attractive to us. And it's for a portfolio of 3 hypermarket food retail properties that we were able to structure in this transaction, including some very nice asset along the Côte d'Azur in the south of France. So if you ever go to the large MIPIM real estate trade fair in Cannes and you fly into Nice airport, I can only encourage you to take the coastal road from Nice to Cannes, and you would basically drive by this asset, which is just one road behind the Mediterranean Sea, in fact. So very happy with the deal, and we hope it will be the beginning of follow-on transactions also with this company, and it's generally something we hope for in any of our deals, that they are a first step for follow-on projects to come, given our long-term nature and our long-term capability to be a partner to our tenants.
Right, so a very typical investment from your niche. And so obviously you invest in many different European countries. You mentioned 20, I believe. In your opinion, which countries or which sectors have the most long-term potential? Is it more southern Europe, like the Iberian Peninsula, or northern Europe? What are your thoughts on this?
It's a very difficult question because they're all quite different and they all have their own positives and negatives about them. And in fact, that's one of the most interesting things I find about investing in Europe, that you have these different regions, different cultures, different languages, different tax systems, different legal systems. And so the markets, they work quite different from one place to another. And navigating that complexity is certainly one of the ways how we can generate a lot of value as well, by knowing how to do that. So to answer your question in terms of preferences for any single market, it's not really like that. It's not that we would say one year we want to invest X $1 million into this particular country. It doesn't work like that. We go where the opportunities are, and we have a large remit in terms of countries that we can invest in. But it might be that we do a certain number of transactions in any particular country in a given year, depending on maybe a local dislocation in the market, or maybe we just see a particular opportunity that works very well and we're able to have a couple of follow-on deals. But then you might not see us transact in that country again for a number of years. It's just the nature of this market, and having that large remit with North America and with Europe allows us to balance it out between those two continents, allows us to balance out between individual countries. So we have the freedom to go where the best opportunities are, and we're not necessarily constrained by having to allocate funds into any particular country. Because what we do is very bespoke in many ways. It is very specific to the company. And so trying to focus simply on one particular region or country would not give you the deal, quite frankly, that we would want to see in our growth as well.
Right. So keeping an open mind. And how do you see the current commercial real estate market in general in Europe? Because in the US, we witness a compression of cap rates. Is it the same thing happening in Europe? Could you give us some insight?
Sure. So markets these days are clearly global and globally connected, and interest rates have been very low now for many years to come. For many years historically, on either side of the Atlantic. And if I had to forecast a little bit, I would imagine that based upon the current central bank policy tones, whether you look at the Fed or you look at the ECB, the European Central Bank, that will probably have lower rates for longer on the European side than maybe the noises that we're having from the Fed, where maybe a bit of a return to normality from an interest rate level perspective is going to happen sooner. That being said, to answer your question, yes, yield compression has been clearly a major theme for years now, in fact. And certainly they have come down even further post-COVID again because of unprecedented liquidity being pumped, quite frankly, into the markets. And real estate is one of the few still, relatively speaking, secure and stable income-producing assets where you can generate real returns rather than bonds, for instance, which are obviously priced at relatively or it's historically very, very expensive levels. So in that sense, the markets have been similar. The markets have been, if you look at compare to Europe and the US, the yields have been coming down, cap rates have been compressing, and certain sectors have clearly done better than others. And both sides of the Atlantic, industrial and logistics, have been big winners in from a real estate asset class perspective over the last couple of years. And I expect that to a degree still to continue because there is a real underlying economic demand for these assets, given what you mentioned earlier as well in the shift towards e-commerce and the growing shift in e-commerce, but also other major macro trends such as reshoring and bringing production closer to demand centers, which will trigger and is triggering increased demand for logistics, production, distribution facilities closer to these population centers. So that is happening, and that is having an impact on the market. It's a certain interesting time to be investing in. But as I always say, and as I have been saying for years, one needs to be careful clearly with pricing and with pricing of deals. and some investments that we're seeing where that set new benchmark record yields. Clearly, one has to wonder that there are probably some very elevated rental growth forecasts embedded into these models, or would have to be embedded into these models to make the return in aggregate actually work. And that's just something we're just generally and naturally very cautious about, just to make sure that you don't turn a good deal into a bad deal by overpaying.
And so, what are your investment goals in the upcoming 3 to 5 years for the European market with WP Carey? Do you have some numbers in mind, or some insights to give us?
Yeah, I think from our perspective, we are very much, at least my personal observation is that we are very well positioned to continue finding opportunities, that we have access to well-priced capital that permits us to find and execute on deals in conjunction, obviously, with the team that we have here based in Europe that allows us to find these opportunities, that has a strong network of relationships. And so we feel very positive and comfortable about our ability to keep growing as a firm. But importantly, and this is a really important point to stress here, to grow at a level where it incrementally adds to the benefit of the firm. Because growth just for the sake of growth is not really to the benefit of our investors. We want to grow in a balanced manner. We want to grow in a manner that is adding incremental, whether it's AFFO per share is, or whether it is from a credit perspective, or whether it's from a weighted average lease term perspective. So this is still the trajectory that we see ourselves for the years to come. And quite frankly, it is testament to the business model that our underlying business premise and our underlying business focus hasn't changed in, as I said, in basically 5 decades. We might have changed from being more, historically speaking, more of an asset manager of funds to now really a pure play or almost pure play triple net lease REIT. But really what we do fundamentally, that hasn't changed. And that goes back to the basic of it is simply a good business model.
Well, thank you for taking the time for being on our radio. It was a great pleasure talking about you and your firm, WP Carey. We'll put your different links and contact information in the bio. So if people ever want to reach out, they can. Thank you guys for taking the time to listen and hope to see you soon.
Thank you so much. Thank you for having me. It was a pleasure.
Real Estate Radio TV, the web radio 100% dedicated to real estate.